Today, a single company produces more than half of India's zinc and aluminum, dominates its domestic oil fields, and is mobilizing $20 billion to build the country's first semiconductor ecosystem. But 50 years ago, the founder of this conglomerate, Anil Agarwal, arrived at Mumbai Central Station at the age of 19. He carried only a tiffin box and basic bedding. For the next decade, he operated as a scrap dealer, buying waste metal from large cable companies and selling it to smaller fabricators. He launched 9 distinct business ventures during this period. All 9 failed. The severe financial strain of maintaining a raw startup in Mumbai eventually triggered a 3-year battle with clinical depression. Agarwal didn't inherit wealth, and he didn't have access to traditional institutional finance. He built the modern Vedanta empire using a much more aggressive strategy. He relentlessly devoured his own supply chain. The turning point arrived in 1976. Using a 50,000 rupee bank loan, Agarwal acquired Shamsher Sterling, a struggling manufacturer of enameled copper cables. The business had a fatal vulnerability. As a cable manufacturer, Shamsher Sterling had to buy raw copper. Anytime the price of copper spiked on the London Metal Exchange, the profit margins on the finished cables were instantly wiped out. This volatility taught Agarwal a harsh economic lesson. To protect profits, fabricating a finished product isn't enough. You have to own the base ingredients. This diagram maps a typical industrial supply chain. At the very end is the fabrication node. In the 1980s, Agarwal established Sterlite Industries, shipping a second-hand plant from the US to manufacture telephone cables. He quickly captured 50% of the domestic market. Yet, despite dominating the final sale, Sterlite was completely reliant on the previous step in the chain. They still had to purchase all their refined copper from state-owned monopolies. To eliminate those monopolies, Sterlite built India's first private sector copper smelter in 1993. By producing his own copper, Agarwal bypassed the middleman and fed raw materials directly into his own cable factories. The ultimate step backward meant acquiring the earth itself. During India's early 2000s privatization wave, Agarwal purchased controlling stakes in underperforming state-owned mining assets like Bharat Aluminum Company and Hindustan Zinc. By applying private sector operational efficiency to these sites, Vedanta secured massive world-class mineral deposits. They had successfully built a fully integrated loop, controlling every step from mining the dirt to shipping the finished wire. Executing a global resource grab required massive capital. To secure it, Vedanta floated on the London Stock Exchange in 2003, raising nearly $900 million. But owning the physical ground brought intense complications. Expanding their mining footprint put Vedanta into direct conflict with environmental regulators and the local communities living on top of those deposits. In the Niyamgiri Hills of Odisha, a major attempt to mine bauxite, the primary raw ore used to make aluminum, was completely blocked following fierce, sustained opposition from the local Dongria Kond tribe. The friction escalated severely in Tamil Nadu. Following violent protests over alleged pollution at the Thoothukudi copper plant, 13 people died in police firing. The state government shut the plant down entirely, instantly removing 40% of India's copper production capacity. Simultaneously, the company faced mounting international legal pressure. UK courts permitted Zambian farming communities to sue Vedanta in London over allegations of groundwater pollution near their copper mines. The unyielding extraction strategy that built the conglomerate had morphed into a massive legal and reputational liability. Facing mounting public interest litigation, Agarwal took Vedanta private and delisted from the London Exchange in 2018. Today, that aggressive expansion strategy has left the parent company burdened with massive debt. Furthermore, stock markets heavily penalize complex corporate structures, applying a conglomerate discount that artificially depresses Vedanta's overall valuation. This animation demonstrates Vedanta's survival strategy. To unlock shareholder value, a sweeping demerger plan will shatter the parent company into 4 distinct, independent entities by 2026: aluminum, oil and gas, power, and iron and steel. Isolating these divisions creates pure-play investments. Institutional investors can now fund specific sectors without taking on the environmental or financial risks associated with the rest of the empire. To secure its next phase of growth, the company is committing $20 billion to pivot away from traditional metals and establish India's first semiconductor and display glass manufacturing ecosystem. India currently imports over $100 billion in electronics annually. Agarwal calls this new initiative technology sovereignty, a bit to solve that massive trade deficit by manufacturing the core components of the digital age domestically. The young man from Patna is executing the exact same playbook he used to survive the copper markets half a century ago. The primary materials of global power have shifted from scrap metal to silicon, but the mechanics of building an empire remain exactly the same.